Loan estimates and closing disclosures are really your roadmap to understanding what am I paying for throughout this mortgage process. Your loan estimate and closing disclosures come to you a handful of times throughout the process, but some of the most important are going to be your initial loan estimate. Now, this is really going to break down everything from the details of the purchase, how much are we buying, how much are we putting down, all the way through to what are the fees and charges for the credit report and underwriting that are on the loan. When you're shopping a home loan or you're shopping a lender against another lender, it's important to understand how to go through these boxes, understand what is a lender charge and what is something that you're responsible for paying as the buyer of the home. So we're going to go through this section by section to make sure you understand exactly what's on here line by line. So starting at the top in the left, you can see this is your personal information, your applicant name, the property that you're buying, and the price that you're purchasing the house for. On the right side, there's going to be some details that are more specific to your loan. What is the loan term? Are we buying this house or are we refinancing this house? Is this a fixed rate product or an adjustable rate product? What loan program, conventional FHA, VA, and is your interest rate locked? And if so, until how long? Moving down a little bit, we're going to get into the actual loan terms that we're signing up for. So you can see on here, we have a sale price of $445 and a loan amount of $400,500, which would be a 10% down payment. The interest rate that is associated with this loan for the here and now is 6.875. And again, you can see from the top that it was not locked, with a monthly principal and interest payment of $2,631. Moving down into a section, we have projected payments. Now this is going to be an important section to look at because some items on here can and probably will fluctuate. But you have the principal and interest portion that we looked at up top. You also have monthly mortgage insurance. How much that you pay a month and how long you pay it is going to be determined on a few different variables, but we'll have to get into that a little later. And then your estimated escrows for a total monthly estimated payment of $3,456. Now, this next number on here, estimated taxes, insurance, and assessments, is not something you add on top of your estimated total monthly payment. That total monthly payment includes those items. It's just letting you know what is going to be escrowed and what is not going to be escrowed. Now, as we move down to the next bucket, cost at closing. This is where important details are going to be. When we think about closing costs, your closing costs are actually fees and charges that are associated with originating your mortgage, and then you actually have your cash to close, which is the total bucket that includes your closing costs and your down payment. And we're going to break these down in detail as we get closer to the bottom. The meat and potatoes of your loan estimate is going to come with the closing cost detail. These are going to be different sections. There's going to be different fees and charges, and who's responsible for these fees and charges is how you can shop lender to lender. Starting in section A, right here, we have our loan costs. This is going to be the actual hard dollar cost of originating this loan. You can see this loan, this buyer is paying $873 for 0.218% in discount points for the interest rate of 6.875. And there's also an underwriting fee of $1,125. Services you cannot shop for. These are going to be items that are fixed to the loan. Again, your appraisal, your credit report, processing, things like that. Section C, these are items that you can shop for. These are going to be your title fees. These are the charges that are going to the title company who is handling the closing of the transaction. Now, you can see on here, there's lender's title insurance, settlement or closing fee, and their endorsements for your house. Other costs are going to be charges that you are responsible for that are going to be specific to your property. Again, your taxes and government fees, that's going to be based off of the home price that you're purchasing and the loan amount. The most important sections that you want to look at on here and making sure they're funded properly are going to be prepaids and escrows. What are prepaids and escrows? So when you buy a home, that home is going to require homeowner's insurance if it has a mortgage. You're going to pay a year's worth of your homeowner's insurance up front at closing. But you also need to fund an escrow account that is going to pay your annual premium for insurance that's due next year. So here's an example. We're closing on this loan on September 10th. That means next year, again, if we're paying for 1 year of insurance, next year, our insurance is going to need to be renewed on September 1st the following year. So if you look down in section G, we're going to have our escrows. Hazard insurance escrow of 3 months. So if we close on a home on September 10th, our first payment is going to be due on November 1st. So if we make November, December, January, February, March, April, May, June, July, August, September, we're going to have 10 or 11 months of payments before our next premium is due. Every month we're making a payment into our escrow account, that $236 times 10, we have 10 months of our premium covered plus 3 months that we set aside. So we have 13 months of our insurance premium set into an account to pay next year's annual premium. And it's always important that we have a cushion here. Similarly, as you go down this next part here for property taxes, setting aside the correct amount for property taxes is going to ensure that you don't get an escrow shortage next year. And this amount, what we set aside, or the number of months that we set aside, is going to be dependent on when your loan closes. Think back to when we talked about insurance just now. The more months we have between when we're closing and when this bill is due, whether it's our insurance or our taxes, the less we have to collect up front. The closer we are to when this bill is due, the less payments that we're making, the more we need to set aside so we don't deal with an escrow shortage. An escrow shortage is where we don't have enough set aside and the lender has to cover the difference for us. All of this gets added up and totaled down here in your closing cost breakdown, calculating your cash to close. You can see $19,232. That's the total of all the sections that we just walked through. The down payment that the borrower has committed to, a credit for the deposit that they put down, a credit from the seller that they were given, and then some other adjustments and credits of things they got from the seller for their estimated cash to close of $50,557. No lender's loan estimates are going to be exactly the same. Each of them are going to have different things that they either charge or don't charge up front. And the reason for that is there are what we call tolerances in the mortgage business that we can't come back to you and say, hey, this was actually 500. I told you it was only going to be 100. There are items on here that a Simplified Mortgage doesn't make money off of that section, but we're responsible for telling you how much it's actually going to cost. Title fees are a big portion of that. We can't come back to you and say, this was $2,700 and not $2,100 like we told you. They'll make us pay for it even though we weren't responsible for charging that fee in the first place. It's important as you get these, if you have questions, we sit down and understand them. But again, knowing that you're not committed to anything that's on this loan estimate until you're actually sitting down at the closing table signing on closing day.